At the absolute peak of the late 1980s Japanese real estate boom, investors looked at this exact patch of land in central Tokyo, the 1.15 square miles that make up the Imperial Palace and its surrounding gardens, and assigned it a truly staggering valuation. On paper, this single moated garden was allegedly worth more than all the real estate in the entire state of California combined. That meant a few blocks of central Tokyo supposedly held more financial value than every tech campus in Silicon Valley, every studio lot in Hollywood, and every stilt-supported luxury property lining the beaches of Malibu. But that math was completely detached from reality. When the pricing mechanisms inevitably collapsed, the resulting crash dragged the world's most aggressive economy into a long period of stagnation known as the Lost Decade. When an entire market starts trading exclusively on infinite optimism rather than actual cash flows, the resulting correction can permanently disable an economic powerhouse. To see how those valuations got so detached, we have to look back to the early 1980s, when Japan's economic growth was based on highly tangible metrics. They were mastering global trade through sheer manufacturing volume and efficiency. Japanese assembly lines were producing cars at a pace and quality level that left international competitors scrambling to keep up. At the exact same time, they were dominating the export of high-end consumer electronics, shipping the world's most advanced televisions, stereos, and video game consoles to living rooms everywhere. If their global dominance was backed by real factories and real products, how did their financial system warp into a highly leveraged casino? There is a massive structural difference between generating wealth from shipping physical goods and generating wealth by infinitely trading paper assets back and forth. The shift began when the Bank of Japan decided to aggressively cut interest rates down to nearly zero. Overnight, borrowing large sums of money became virtually free. With debt that cheap, buying properties stopped being about securing a place to live. It became a highly speculative trade. This chart shows the exact mechanical loop they built. Investors started taking out massive loans against the equity in their homes, specifically to buy shares in the booming stock market. Then, they used those exact shares as collateral to take out even larger loans, which they used to buy up more commercial and residential real estate. The rising real estate prices drove up the balance sheets of the companies that own them, which pushed their stock prices higher, which then provided more collateral to borrow and buy even more land. As long as the central bank kept the cost of borrowing near zero, this mechanical loop guaranteed that the paper wealth of the entire nation would continue to multiply. The sheer velocity of these returns eventually eroded basic financial caution. A national consensus formed that domestic asset prices would simply never decline. It was the exact same highly leveraged optimism that drove American markets right before the crash of 1929, where margin loans allowed buyers to write continuous market highs with a fraction of their own cash. Investors completely stopped looking at actual corporate profits or revenue, much like the tech investors of the late 1990s who threw millions at unprofitable internet startups based entirely on market sentiment. If you asked a boardroom executive to justify why a small corporate plot was worth tens of millions of dollars, they would repeat the exact same rationalization heard in every historic mania. This time, it's different. The math no longer mattered. The market was surviving strictly on collective agreement, staying afloat only because buyers and sellers mutually agreed to stop asking how the debt would ever be paid back. By late 1989, the Bank of Japan finally looked at the staggering amount of domestic debt and realized the market was completely overheated. To cool the speculation, they sharply and aggressively raised interest rates. Making debt expensive immediately broke the feedback loop. The continuous flow of cheap cash that the entire real estate market relied on was abruptly severed. Without new loans to keep buying pressure up, the Tokyo Stock Exchange went into a violent freefall, echoing the catastrophic sell-offs of 1929. The properties themselves hadn't changed, but the massive valuations attached to them could only exist in an environment of unlimited, practically free leverage. The financial institutions that had issued these massive loans suddenly realized their entire balance sheets were backed by wildly overpriced land that nobody could afford to buy anymore. They were holding portfolios of totally illiquid, toxic collateral, a structural failure that closely mirrors the implosion of American mortgage-backed securities in 2008. Because of that initial cross-ownership loop, the contagion spread everywhere. Cratering land values destroyed corporate stock portfolios, which in turn severely damaged the manufacturing sector's ability to operate. The resulting paralysis forced the country into a prolonged era of severe deflation and economic stagnation, from which their markets have spent 30 years trying to recover. When the collective agreement to ignore the math finally breaks, all those trillions of dollars in paper profits disappear instantly, leaving behind a very real, very heavy mountain of debt. Thanks for watching Irony Economics. If you enjoyed this look into the madness of the markets, hit that like button, subscribe, and let me know in the comments which multi-billion-dollar disaster we should decode next.